Understanding market risk. Risk means different things to different people. I have some people that will call me and say, Allan, I want to have lower risk in my portfolio. I said, okay, so you want to own, low risk bonds, interest paying investments, fixed income. No, I want to own bank stocks. And I look at them and I say, well, bank stocks are actually medium risk. They're not considered low risk. Anything in the market can go up and down. Any stock that is trading on a stock exchange, whether it's the TSX, NASDAQ, New York Stock Exchange, wherever it is, these things can go down. And so, yes, these investment ideas are medium risk, although to a certain person, they may think it's low risk because they believe that nothing could ever happen to the Canadian banks or the banks in general. And so for me, I have to explain to them that, yes, you are correct. They are perhaps less volatile than other medium risk investment ideas, but they are medium risk nonetheless. Others will tell me, what about gold? Maybe I want to buy some low risk gold. Well, to me, I don't think gold is low risk. I know before our show today, gold was way up. I think it was up like $80 an ounce. A couple of last week, I think it was down, or the week before that, it was down. I think $500 an ounce for the week. Went from 4,400 to 3,900. Now it's back at 41, 4,200. It's moving all over the place. 10% to the up, 10% to the down. Is that a low risk investment? So I thought for our show today, we would talk about different types of risk. And we actually have a chart that we can pull up. I know it's going to be perhaps hard to read all the different types of risk, but I thought I would go through some of them. The first one off the top, market risk, right? And the market risk is the risk that your investments may decrease in value due to economic developments or events that affect the entire market. Those can be, as we've seen over the past year, political in nature, tariffs, geopolitics, trade between countries. That has definitely affected the stock market. And that's market risk when markets go up or down. And we can also call that equity risk, the risk that share prices in general will fluctuate. But there also is interest rate risk, the risk that if interest rates go up, the price of your low risk bonds can fall. And so when people buy bonds, low risk, A rated for a 4% interest rate or whatever you're buying it for, 3% these days, the bond price can actually fall. You can actually see a negative number with respect to a capital loss. Now, we know that if you hold to maturity, you will get your money back and you will earn the interest until you get your money back. So those investment ideas, yes, there is interest rate risk there if you were to sell them, but there is such a thing as interest rate risk on low risk money. GICs, that is another type of interest rate risk, because if you buy a GIC today, and let's say you were to buy a 3-year GIC, and let's say interest rates were to start moving up in the next 6 to 18 months, well, your GICs that you bought 3 years ago would definitely not be making it nearly as much as interest rates are making today. And so there's always that risk. And other risk that with respect to GICs is liquidity risk, which is also on our list. GICs are not liquid. A lot of people ask me about GICs, and I say to them, okay, we can buy a GIC, but if you want to earn a rate of 3%, you can't cash it. They're non-cashable. Cashable GICs are probably paying you 1 to 2%, so significantly lower interest. A lot of people ask me about alternative investments, alternatives to the stock market, and we hear about them. Second mortgages or real estate investments are ones that people like to talk about. A lot of those investments are illiquid. You can't get out when you want to. There's only certain times of the year where whoever's selling the product, whoever's managing that product, allows you to get out, and that money has to be available for them to pay you out at that time as well. So liquidity is another big factor, in my opinion. Currency risk, that's another one, right? You take your Canadian dollars, you buy something in US dollars, and let's say the Canadian dollar moves a lot higher. Well, then when you bring back those US dollars back to Canadian, then obviously you will have a little bit less than when you started. Commodity risk, talked about that with gold. Commodity risk is the risk that commodity prices will change and impact the value of an investment. Concentration risk, we talked about that as well. Staying diversified. Reinvestment risk, the risk of loss if you reinvest your investment returns at a lower interest rate. Inflation risk, we all know that one, right? Inflation risk, if you just keep your money in your bank account or in a shoebox in your backyard, you're losing about 3% a year in the US, probably about 2.5% a year on spending power of that money here in Canada. So we all know after taxes, if you're not making 3% return on your money, you're not keeping up with the rising costs of living and all the costs around you. So these are examples of all the risks that exist today, or at least most of them anyways, all the risks that an investment advisor should be advising you on, should be keeping in the back of their mind, all the different types of risks for all the different types of investments. And market risk is the one we talk about, I guess, most. But as you can see, there are many other types of risks that you as an investor need to be mindful of.